welcome to the Killick & Co podcast for the 14th of October. Last week equity markets managed to post gains. Monday and Tuesday of last week did see some weakness as fears mounted regarding the approaching deadline for the US debt ceiling. But towards the latter end of the week, equity markets did stage quite a strong rally to finish up on the week, and this was largely centred on optimism that at least a deal extension could be negotiated over the weekend. In fairness, that hasn't come to fruition over the weekend, but markets are still opening Monday in the positive territory at the moment, so taking a lot of this in its stride. The focus, of course, will be on the 17th of October this week as the expected timing for the debt ceiling. Although there is a feeling around that with tax receipts that actually the 17th of October isn't the critical date. In fact, they can manage their way through that particular date. Two important dates, though, 23rd and 31st. For Social Security and interest debt repayments will probably be the bigger trigger. Now today it's Columbus Day in the US, so some markets in the US are closed. Canada is closed, for example, and the bond markets are closed in the US, but it is expected that negotiations will begin today. So that really is the start. If we turn to the diary for the forthcoming week outside of that, really probably the key piece of data will be the German ZEW survey, giving some indication of business confidence in Europe at the moment. Here in the UK, we have UK inflation due. That number is due in terms of Tuesday morning, and the expected number there on inflation is around 2.6% on CPI, 3.2% on the RPI number. So both numbers just a touch softer than the previous month. On Thursday, we have UK retail sales. Now, there has been some feeling that September was a more difficult month for retail sales. Indeed, stocks like Marks and Spencer and Next did have quite a wobble towards the end of the month into October on feelings that that extended summer for Britain had delayed the purchase of the autumn ranges. But nevertheless, the number is expected for 2.2% retail sales growth in September, so broadly reflecting the sort of rate of inflation that we are seeing at the moment. So just turning to some of the sort of key charts. The first chart that I wanted to highlight is really where is this debt ceiling sort of manifesting itself in the charts? Well, in fairness, most of the bond market's remaining very stable at the moment, but the chart I'm showing here are the very short-dated T-bills. This is one that the maturity is due on the early first week of November, and you can see how yields have risen on the very short-term dated T-bills at the moment. So this is really where the noise is happening at the moment, and you can see there that yields have risen by more than fivefold over the course of that time. This is the US 10-year, and you can see there that that has remained largely undisturbed. Sort of key news from last week was the nomination of Janet Yellen as the new Fed governor. And if that all passes through, she is seen to be more of a dove than a hawk, that she doesn't see inflation being the biggest risk at the moment, but full employment being the sort of key target for the Fed. She's sat really on the shoulder of Ben Bernanke for the last 2 or 3 years as deputy, so a lot of the sort of current policy is her work, or she's been party to that work. So it is a sense that policy will remain largely unchanged, but to continue that extension of the tapering, possibly under her stewardship, and therefore the key question is, do we taper before she is appointed in January? She'll probably come in during the course of March, or will they taper before? The feeling at the moment is that the currency markets and the bond markets have remained pretty stable during the course of the week on her appointment, so that should be a relatively seamless move there. So just turning back to some of the sort of key charts for last week. Well, first one I want to pull up is really the FTSE volume. This is a chart showing the number of shares traded under the FTSE 100, and you can see there this very sharp movement lower in volumes at the moment. Really wanted to highlight that as just an example of the sort of paralysis that seems to be affecting in financial markets at the moment running into this debt ceiling, and therefore this is a volume that's more normally akin to a sort of Christmas Eve or a New Year's Eve period. So volatility and volumes certainly much lower at the moment. In terms of some sectors, though, that are feeling the full force of the debt or the budget shutdown in the US, it appears the defence stocks are suffering most. This is a company called Chemring, which is a smaller defence operator, but you can see their shares crashed by about 25% last week on the back of feeling that their last quarter is going to be poor as a result of the shutdown. But it's not just the smaller companies. Just looking at a range of companies in the defence sector, Raytheon has come off recently. BAE Systems, which in fairness has been one of the top performing FTSE 100 stocks during the course of 2013, is starting to come under some sort of pressure there. In that sector. We are also in the midst of the US corporate reporting season. Last week we had numbers out from JP Morgan, which were very good, and indeed we also had numbers out from Wells Fargo, which is a Killick recommendation in the financial sector, and again those numbers very resilient at Wells Fargo. During the course of this week we will hear from Google. You can see there that Google has found a sort of trading range of $850 to $900 since May of this year, so looking for those numbers, Q3 numbers, to possibly break them out of that range. And Goldman Sachs as well will be announcing their results during the course of this week. Again, sort of reasonably range bound during the course of the last few months. Finally, really just to cover off the FTSE 100, where are we sort of year to date? Well, the decline that we've seen, the sort of 6,600 retracement that we saw during the course of September, bottomed out at around 63.24, but we're back up to 64.90 as we're trading. So still very much in that what I refer to as the 6,400 to 6,600 range. As I say, if we can make some progress this week on the debt ceiling, then hope to see that sort of range broken out at least to the upside.